Welcome all to Corporate Issuers Learning Module 4, Working Capital and Liquidity. And after the first 3 modules, this is going to provide a welcome change of pace, I think. Few numbers to look at, a couple of ratios, and a big overlap with the world of financial statement analysis. So when you get to FSA, you're going to see a lot of this analysis again, which is great news, shortening the curriculum. Now, before we get into the 3 LOSs that we need, let's just look at a very quick overview of what we're talking about when we talk about working capital and liquidity. Definitions, first of all, at the top. What is working capital? And that is a little bit of a loaded question because it depends on the analyst. You can define working capital however you like. The basic idea, however, we are looking at short-term assets and short-term liabilities. So current assets and current liabilities. Working capital in the most basic sense is just your current assets less your current liabilities. However, what we're really trying to do here is have a look at how the business operates. We'll see in a moment, we're looking at its operating cycle, its cash conversion cycle, how it turns cash into more cash by buying raw materials, turning those raw materials into a product, selling them and collecting the cash. So another measure of working capital defined here in the curriculum is net working capital. That focuses more on those current assets and current liabilities that are intrinsically related to that operating cycle. So it'll take current assets, remove cash and remove marketable securities because they're just sat there on the balance sheet, not really part of the actual cycle. They're a result of it, or at least cash is, but not part of the cycle. Current liabilities will take out any short-term debt or current debt. 2 related terms they use here in the curriculum. Really, it means any debt that's showing up as current. So it could be a short-term piece of debt. When you took out a loan, it was repayable within a year. It will be classed as short-term. Current debt is referring to any portion of your long-term debt that is due within a year. So you could have a 5-year loan that's amortizing, meaning you're paying off principal over time. The amount of that long-term debt that is payable within a year would be current debt. So slightly different terms, they mean the same thing. Let's take current liabilities and get rid of any debt. So we're just left with those liabilities that are again related to the cycle. That's our definition of, or our definitions of, working capital and net working capital. Liquidity, couple of different ways of referring to liquidity. When we're talking about issuer liquidity, we're talking about the ability of the issuer to pay back its short-term liabilities. If you have enough short-term assets and other sources of liquidity to pay back your short-term liabilities, you are liquid. If you don't, you could very well be in trouble. Now, just a very simplistic way to look at this as a kind of overview. On the left here, we have a simplistic looking balance sheet. Long-lived assets at the top. So that's your property, your plant, equipment, what you're using to drive revenues. Current assets to give total assets. And at the bottom, your financing, current liabilities, long-term debt, and equity. And the balance sheet, as you can see, balances. We'll see obviously a lot more of this in financial statement analysis. But let's take that same simplistic balance sheet and rewrite it. Long-lived assets we'll just leave here at the top, but we'll combine our current assets and our current liabilities together, 2,000 less the 500 to give working capital of 1,500. And then we'll leave debt and equity at the bottom, but just call it invested capital, all of the capital we've used to invest in our business. Now, when we look at the balance sheet like that, it gives us a kind of flavor of what we're talking about in this module. We have raised 6,500 in capital. What are we using that capital for? 2 things. Number 1, we are investing 5,000 of that capital into long-lived assets, which are going to generate revenue for us. But to help us generate that revenue, we have to have some of that capital tied up as working capital. What are we talking about? We defined it as current assets. What's actually in there? Inventory, accounts receivable, cash. You need inventory levels to make sure you can meet your sales requirements. You're going to have accounts receivable because you have to give customers credit terms. But the downside is when you have cash sat on the balance sheet, inventory sat in your warehouse, accounts receivable that you haven't collected, they are costing you money. Working capital costs you money. And you can see that from this simplistic balance sheet. We've had to raise capital of 6.5. 1,500 of that is sat there, tied up in working capital, costing you money. 5,000 of it is invested in long-lived assets, generating revenue. So the focus of this module is to say, well, how much is in working capital? How much is it costing us? And can we minimize that to minimize that cost? With that said, let's get into it. Our first LOS, explain the cash conversion cycle and compare issuers' cash conversion cycles. And I know I've made this point already, but I'm going to keep making this point every time it's relevant. The cash conversion cycle is covered in detail in financial statement analysis. So you're going to have 2 cracks at looking at this, which is great news. We'll cover it here, but we're not going to spend too much time calculating all the ratios behind it because you'll get plenty of practice at doing that in FSA. But let's take a look at it. First of all, we'll define the operating cycle. And as it says here on the slide, it's most helpful to think just of a basic company that makes and sells physical goods. We buy raw materials, we turn them into a finished product and we sell it. Our operating cycle is this yellow circle. So we can kind of start anywhere we like, but let's start here. We have some cash, we've raised capital. We're going to use that cash to make purchases. Those purchases of raw materials will be turned into finished goods via a production process. Those finished goods will then be sold to our customers. And then eventually, we will collect cash from our customers. We're back to the start and off we go again. So in white, you have your operating cycle. The cash conversion cycle specifically measures how long it takes to go round that operating cycle and turn your initial cash into, hopefully, more cash. Now, the cash movements don't happen exactly at the same time as your operating cycle. For example, step 1, we said we made a purchase. It is likely that you have credit from your suppliers, so you don't pay up front. You will make a purchase, you will owe them cash, and you'll pay that cash at a later date. That leads to accounts payable. If you make a purchase but you haven't yet spent the cash, you'll see on the balance sheet accounts payable. That is a current liability. It's part of working capital. The raw materials you've actually purchased, that's your inventory. Until it's sold, that is sat in your warehouse, either as raw materials, work in progress, or finished goods. It's a current asset. It's part of working capital. Once they are turned into finished goods and sold, again, it's unlikely that the cash transaction happens at the same time as the sale. You are likely to give your customers credit. So when you make a sale and you don't collect the cash, you'll see on the balance sheet accounts receivable. Accounts receivable, a current asset, part of working capital. So we can track what's going on with the cash conversion cycle by tracking what's going on with our accounts payable, our inventory, and our accounts receivable. And we can summarize it nicely by looking at this little timeline. Starting on the left, step 1, we purchase goods. Hopefully, as we said, you have credit from your suppliers. So although you purchase your goods here at, let's call this T0, for example, you don't yet pay for them. You pay for your goods here. The gap between purchasing your goods and paying for your goods, we can measure using a ratio called Days of Payables Outstanding, DPO. It is literally a measure in days. You will see in FSA how to calculate it, and we'll do a little brief example shortly in here. But all you need to know at the moment is using the financial statements, it's very easy to find out on average how many days does it take you to pay your suppliers. Well, let's say, and I'm just making numbers up randomly here, let's say it takes you between purchasing the goods and paying your suppliers on average 51 days. 51 days is your days of payable outstanding. Now then, why have you purchased those goods? You've purchased those goods because you're hoping to turn them into a finished product and sell it. So we sell that finished product here. The time between buying your goods, so the raw materials arriving in your warehouse, and selling those goods, we measure as the days of inventory on hand. How long is inventory in your warehouse before it is sold? Again, very easy to calculate from the financial statements. Again, we'll see an example in a moment, but let's just make one up here. Let's say, on average, inventory stays in your warehouse for 73 days. There's your days of inventory on hand. You've sold the finished product, but as we said, you're unlikely to get the cash at the date of sale. You'll give credit to your customers. So it's a later date when you collect the cash. The time between making the sale and collecting the cash is when you'll have accounts receivable on your balance sheet. That length of time we can measure again very easily. We call it the days of sales outstanding. Let's say on average it takes you 56 days to collect from your customers. 56 is your days of sales outstanding. The cash conversion cycle we can see here in yellow rather. That measures the time between the two cash flows. Cash going out to your suppliers and cash coming in from your customers. It is the time between paying for goods and collecting. You can calculate it by adding together the days of inventory on hand, that'll take us from here to here, plus the days of sales outstanding, that's the whole length of the timeline, less the time you take to pay your suppliers. Hence, DOH, the days of inventory on hand, plus your days of sales outstanding, less the days of payables outstanding. Now, in my simple example, 73 add 56 minus 51, that would give you 78. 78 days between paying your suppliers and collecting cash. Sit back and think about that for a moment. What does it mean? It means we have an outflow 78 days before the inflow. That gap, that cash conversion cycle, needs financing. The longer it is, the more it's going to cost you to finance it. So if we're studying working capital, thinking liquidity, trying to minimize our cost associated with working capital, we will be looking to minimize that cash conversion cycle. How can you do that? Well, you can analyze its three components. Days of inventory on hand, you can try and get inventory out of your warehouse quicker or delay it coming in. Days of sales outstanding, you can try and collect cash from your customers quicker. Days of payables outstanding, you can try and lengthen those because they reduce your cash conversion cycle, take longer to pay your suppliers. Now, what is an average cash conversion cycle? Well, it just so happens that 78 days is the average, or I should say was in 21, the average cash conversion cycle of all companies in the S&P 500. But it will depend on your industry exactly what it looks like. Some will be shorter, some will be longer, just by the nature of the industry and their business model. So let's take a look. This is the number I just talked about. 78, the average for all companies. I lied to you when I said it was 2021. It was 2020. Apologies for that. This is from the JP Morgan Working Capital Index. You can find that online. Have a look at it. It's kind of interesting. I disagree with some of the numbers that have been analyzed here, but roughly speaking, it's about right. So it's, we don't need to stress about it. But just a little example here. We've got, as you can see, a whole range of industries, but I've left two off here. The two that are missing, 12 days all the way down here and 180 up here. Two that are missing are airlines and pharmaceuticals. So pause the video, don't Google, don't cheat, but pause the video and just think for a moment, which is which? Which is going to sit there at 180 and which do I think is going to sit there at 12? Think of the components. Days of inventory on hand, days of sales outstanding, days of payables outstanding. And once you've considered it, let's reveal the answer. Did you get it right? Pharmaceuticals is the 180, airlines is the 12. Why? Think about how much inventory airlines have. Very little. I mean, they will have some inventory, all the stuff that goes onto the carts to get served and so on, but very little. That's the nature of the industry. Think about days of sales outstanding. If you buy a flight, you pay up front. Hence a very short cash conversion cycle. That is just the nature of the airline industry. As opposed to pharmaceuticals, who have huge levels of inventory. Most of that 180 is days of inventory on hand. I think it's about 163. When I do the analysis actually from this report, I actually get, rather than 180, I got it to come to 160, but 20 days either way, the point is still valid. But 163 days of inventory on hand. Some of that inventory is required by law. Regulation says they have to have a certain stock. So a long cycle may just be a function of the industry. Airlines, on the other hand, very short. So don't panic. Don't go in as an analyst and say, average for the S&P 1500 is 78. This pharmaceutical company is 160. They're inefficient. That's terrible, and so on. It's the nature of the industry. Similarly, this isn't the best company in the world if you look at an airline and it's 12. It's just a function of their business model. However, if you're looking within pharmaceuticals or within airlines at their peers, then yes. If the average for airlines is 12 and you look at one and it's 28, okay, that might be problematic. Maybe you can say then they're being inefficient and look into it in a little bit more detail. Now, I said we were going to do lots and lots of examples in FSA. If you're looking at this stuff and it's grabbing your attention and it's exciting, then feel free to jump straight to FSA Learning Module 11 and see a lot more of it. But we'll just do one quick example here just to show you what you need from the financial statements to calculate this cash conversion cycle. And this is for Inditex. I'm not going to try and pronounce that and butcher it. Inditex, whose largest brand is Zara. It's a clothing manufacturer and retailer. And we're going to calculate its cash conversion cycle. Remember, we said airlines was very short at 12. On that previous chart, there was a category, apparel retail, so selling clothes, and that average was higher than the S&P 1500 generally. It was up, I think, in the hundreds. But let's look at this particular clothing manufacturer and retailer. What we need from the accounts to calculate the cash conversion cycle is accounts receivable, here it is, inventories, and accounts payable. We have this info for 2021. We will need from the income statement sales and cost of goods sold. Now you'll see this in a bit more detail in FSA, and specifically there, we'll say we should really be taking the average accounts receivable, average inventories, and average accounts payable. Fine, it doesn't make too much difference here. We're just doing a quicker rough and ready calc. How do we get to the numbers we need for the cash conversion cycle? First of all, days of sales outstanding. We're going to take our accounts receivable figure of 842. We are going to divide that by sales for the year of 27,716 and multiply it by 365. That's the number of days in the period we're looking at. So here we're looking at a set of annual accounts. That will give you 11. On average, takes Inditex 11 days to collect cash from customers from their sales. Makes sense that it's very short, I think. You walk into the shop and you pay for goods. So most retail customers will be paying immediately. Some larger buyers may have credit terms. Some retail customers may have loyalty cards that they don't pay off, or store cards rather, that they don't pay off immediately. Days of inventory on hand. We are going to take, once again, the balance sheet figure, this time for inventory, obviously inventories, on the top. We're going to divide that by the income statement figure that's relevant for inventories, cost of goods sold, on the bottom, and multiply it by 365, we'll get 93. Between getting the raw materials in, selling the finished goods, 93 days. And finally, DPO. Balance sheet figure again, this time is accounts payable, divided by, again, cost of goods sold, 6199 over 11902 times 365, 190. It takes this company 190 days on average to pay its suppliers. Add those three together and you actually get a negative cash conversion cycle. We said earlier on we were looking to minimize this cash conversion cycle because financing it costs you. This is the exact opposite. Zara is getting cash in from its customers before it's paid its suppliers. That suggests they have a competitive advantage. They are strong in their industry. People want to do business with them. They want the contract to supply Zara. They are willing, therefore, to give pretty generous credit terms, or at least, I guess, put up with quite late payment. This is so short, it's gone negative. That actually frees up cash to use elsewhere. They're not financing this. They are getting cash in before they pay it out. How do you achieve that? That's why we have these three ratios. Break it down. You could first of all reduce days of inventory on hand. How do you do that? You discontinue products. You have more frequent deliveries, a just-in-time system. A lot of retailers try this. They know one of their big costs is storing inventory. If they can get inventory in just before they need it, that brings down your days of inventory on hand, saves you costs of inventory, obsolescence risk, insurance, storage, etc. Passes that on effectively to the supplier. So a lot of the big grocery stores will do this. They'll have suppliers who again want the contract. They want this huge contract to supply you. They will have to agree to terms that if the grocery store demands 18 tons of potatoes, you have to be able to deliver that within 48 hours. It arrives at the back of their store. They put it straight on the shelves and it gets sold. Now, Zara, fashion industry, big problem in the fashion industry is inventory. You have to meet changing trends. So you have to typically keep huge ranges, huge amounts of inventory to meet changes that you really couldn't predict. Zara books that trend. They are famous for doing short runs. This is what we're going to make. We're going to get it manufactured as quickly as we can, onto the floor, sell it off the rack. They don't keep hundreds of different lines and days and days and days and days of inventory. You could also reduce your days of sales outstanding, get cash from your customers quicker. You can do that by giving prompt payment discounts. Clearly, there is a cost associated with that, so you've got to weigh it up. Charge late fees. So, carrot and stick here. Tighten credit standards. Don't sell to customers that you don't think are going to pay quickly. Again, there's a cost there because that might reduce your sales overall. Take upfront deposits, or be in a business where people pay upfront. Or get third parties to come in and collect your accounts receivable. There's going to be a cost with that again. But if that's their job, their specialty, they might be able to do it more efficiently than you. Or you can increase DPO. Up to 190 would be nice. How do you do that? You negotiate terms with your suppliers. If you have the power in the relationship, you'll be able to do that. You can stretch out your DPO, but be careful. If you stretch out your days of payables, you may miss out on prompt payment discounts yourself. And that could be costly, as we are about to see. Because missing out on a discount can actually be a crazy decision. Let's have a look at this example. We have standard payment terms from a supplier that look like this. 30 days. That's when we have to pay. So we're going to assume if we don't take advantage of the discount, we are going to pay after 30 days. But there is a 2% discount for paying within 10 days. Now, the standard notation for that is to write 2/10 net 30. The first number here, that 2, is the percentage discount. /10, that's when you'd have to pay to get the discount. Net 30 tells you would normally pay after 30 days. We can work out the cost of ignoring that discount, because effectively, if you pay after 30 days instead of 10, you're effectively borrowing from the supplier for 20 days. The 20 is obviously the gap between the normal terms and when you have to pay to get the discount. Think of it like this. Imagine you owed a supplier $100. If you pay within 10 days, you get the 2% discount. You would only have to pay $98. If, on the other hand, you wait until day 30, the latest you could, you have to pay $100. That is effectively borrowing. The cost of borrowing is the $2 discount on the $100. So the $2 is the dollar cost for 20 days. As a percentage, over 20 days, that's 2.04%. How did I get that? $2 over 98. You've effectively borrowed 98, and then in 20 days, you had to pay back 100. $2 of interest effectively over 98, 2.04%, but that is over 20 days. If we want to express that as an effective annual rate, EAR is your effective annual rate. This we know from the world of quant. You take 1 plus that rate, so 1 plus 0.0204 to the power 365 to annualize, divided by 20, the number of days between our normal payment and our discount, minus 1. That is an effective annual rate of 44.6%. That is madness. What does it mean? If this discount is on offer, you should take advantage of it. Problem may be, you don't have the cash available, the liquidity available to take advantage of it. Well, if you don't, borrow. As long as you can borrow here at an effective annual rate less than 44.6%, and let's hope we can or we're in real trouble, you can borrow at an effective annual rate less than 44.6%, you should borrow and pay early, and you'll still come out better than you would by delaying and missing out. Now, that's how I like to lay out this discount calculation, because I think it's nice and intuitive. You can see exactly what's going on. And if that works for you, anytime a question comes up on this discount, just do this. Say, okay, imagine I owe 100. Let's work out the discount, the dollar cost, the periodic cost, and the effective annual. But if you're happy with it and you say, come on, Richie, I've done this in quant. This is pretty easy. Okay, fine. This is the general formula. You can just, need the minus 1. You can just use that. You're taking 1 plus the discount percentage over 100% minus the discount percentage. That gives you your 1.0204 to the power 365 over. Payment period here was 30. Discount period was 10. 30 minus 10, 20. Minus 1 gives you that 44.6%. So that's the cash conversion cycle. Let's move on and take a little look at working capital. We had two definitions earlier on, working capital and net working capital. Let's just make sure we can calculate them. Why are we calculating them? Well, as we said, lower working capital means more efficient operations. If we can get working capital minimized by being more efficient, we will lower our cost. Remember, working capital is sat there on the balance sheet costing you money because you have to raise capital to finance it. We'll calculate working capital. Typically then an analyst will take that working capital and compare it to sales. Do a working capital to sales ratio. Why? Allows you to compare firms of different sizes. Again, something you'll see in FSA. Simple balance sheet here. We have cash, marketable securities, accounts receivable, inventory, and prepaid accounts. That's everything in current assets. Current assets is 335. We have accounts payable, what we owe our suppliers, other accrued expenses, and a short-term bank loan. Because it's short term, it's part of current liabilities, 220. Working capital would be 115. Net working capital, remember we wanted to focus on what's involved in that cash conversion cycle, in the operating cycle. So we ignore cash and we ignore marketable securities. So take your 335, knock out the 40, knock out the 70. In current liabilities, we ignore our short-term or current debt. So we'll knock out the 60. That will give you 225 minus 160. Net working capital would be 65. And working capital levels and the cash conversion cycle are positively correlated. If you have a shorter cash conversion cycle, you will have less working capital on your balance sheet. Reduce one, you'll reduce the other. The opposite is also true. If your cash conversion cycle starts to lengthen, then you're going to see more working capital on the balance sheet. It's going to cost you more to finance it. Let's confirm that relationship holds by looking at Zara again. Now, as I've noted, more of this in FSA Learning Module 11 if it's exciting you. This is exactly the calculation we looked at earlier, getting down to the cash conversion cycle of negative 86. We can now use the information from the balance sheet to calculate net working capital, accounts receivable, and inventories in our current assets, less our current liabilities, 6199 from the balance sheet, gives negative net working capital of 2315. Divide that by sales. It's a working capital to sales ratio of negative 8.35%. Now we'd want to go on and compare that to last year, to forecasts, to its competitors to really kind of get behind how interesting it is. But the only point we're trying to prove here is that if you have a very short, or in this case, negative cash conversion cycle, you tend to have very low, or in this case, negative levels of working capital. Now that's a lot of me talking. Let's do some examples. Make sure this is stuck. Let's look at the impact on the cash conversion cycle of some different choices a firm makes. First of all, the firm is going to offer larger discounts to customers for prompt payment. The idea there, customers are going to pay quicker. If they're going to pay quicker, that should reduce your days of sales outstanding. If you reduce your days of sales outstanding, you should shorten your cash conversion cycle. Secondly, a lower reliance on just-in-time inventory methods. We said that meant more frequent deliveries, getting inventory into the warehouse just before we sell it. That reduces your inventory holding period, your days of inventory, and reduces your cash conversion cycle. So here, be careful of the wording. If we're going to put a lower reliance on that, not focus on just-in-time and frequent deliveries, that's actually going to increase your days of inventory on hand, which in turn will increase your cash conversion cycle. Why would you do that? Well, this is a risk. You're trying to minimize your inventory. You do risk stockouts. If you don't get it right, you might not have enough inventory to meet demand. Thirdly, you could negotiate longer payment periods with suppliers. Longer payment periods with suppliers will increase your days of payables outstanding. You take longer to spend your cash. That reduces your cash conversion cycle, reduces the gap between paying out and receiving cash from customers. And you could tighten credit standards for customers. Don't take on people who you think are going to take a long time to pay. That should leave you with customers who pay quicker. Should bring down your days of sales outstanding and reduce your cash conversion cycle. If you get those, you're in business. Note, we are just talking about the length of the cycle here. There are obviously other considerations, because if we tighten credit standards for customers, maybe that means some customers won't buy from us. It might impact your levels of sales. But that's not what we're talking about here. We are just talking about the length of the cash conversion cycle. Another example, let's just revisit that supplier credit. Make sure we understand what's going on there. an issuer is considering borrowing at 15% to take advantage of supplier terms of 1/14 net 30, and they're going to pay on day 14. Let's first of all interpret what this means. The 1/14, that is a 1% discount if you pay within 14 days. It's an oddly specific number. 2 weeks, I guess. At normal terms, net 30, so normal terms, you pay within 30 days. So we're getting a 1% discount if we pay 16 days earlier. Taking my approach again, my quick calculation, imagining $100. If we pay on 14, or rather day 14, we pay $99 instead of the 100. There's the 1% discount. The cost over 16 days is therefore $1. The cost as a percentage is the $1 over 99, 1.01%. Is it worth borrowing at 15% to save that 1.01%? It probably is, because that's quoted annually. Whenever they throw an interest cost at us, it will be stated annually. So to compare, we are going to need to annualize this, the effective annual rate, 1.0101, or if you're using the general formula, 1 plus the discount percentage divided by 100% minus the discount percentage, annualized using 365 days over 16 days, the number of days we have to pay earlier, minus 1. That will give you 25.8%. Is it worth borrowing at 15% to save an effective interest cost of 25.8? Yes, it is. If you borrow at 15 and save 25.8, you are coming out on top. Next up, liquidity. Explain liquidity and compare issuers' liquidity levels. Let's do it. Definitions first of all. If we are talking assets and liabilities themselves, so things like cash, accounts receivable, inventory, liquidity is the nearness to cash or settlement. How quickly will it turn into cash? Or for liabilities, how quickly will you have to pay it? For assets, going from the most to the least liquid, cash is the most liquid you can get because it's cash. Next up, short-term investments. Short-term investments are those that you can readily turn into cash quite quickly without loss of value. Next, accounts receivable, you have to collect from your customers to turn it into cash. And then inventory. Inventory has to be sold, turned into accounts receivable before it's then collected. That could be not that liquid. Depends on your business model, your operating cycle. Take it to extremes. Think of a distillery. You may have whiskey sat in a barrel that's going to sit there for 25 years before it's sold. So inventory might not be available to meet your short-term liabilities. Looking at liabilities, more liquid, accrued payroll, you have to pay that pretty quickly. Then accounts payable, because you do at least have your credit terms before you pay it. A lease payment due in 1 month after that, and then your short-term debt. So that's liquidity of individual assets and liabilities. What about the issuer, the firm itself? The firm's liquidity is a measure of its ability to meet short-term liabilities. It in turn depends on the amounts and the liquidity of your short-term assets and liabilities. You would like to have a bunch of liquid short-term assets that you can quickly liquidate to pay off your required short-term liabilities. Whether you do or not depends on your business model and, old friend, cash conversion cycle. If you end up in a situation where your short-term liabilities are greater than your cash, you have to find another source of liquidity, whether it comes from these or whether you have to look elsewhere and raise some more finance. And what might those sources be? Hopefully, primary sources. This page shows us our primary sources of liquidity. They are most readily accessible or rather they are the most readily accessible form of cash that you have. Using them is unlikely to affect your ongoing operations. So these are the sources of liquidity that you would expect to use on a daily basis to fund your operations. First of all, cash, obviously, and marketable securities on hand. You can sell marketable securities quickly without loss of value. Borrowings. You've got bank borrowings, you've got bondholders who invested, you've got supplier credit. Remember, we looked and analyzed supplier credit in the last LOS. And you have cash flow from your business. That, hopefully, is your primary long-term source of liquidity. You generate cash from your business model, from your cash conversion cycle. Because that's your primary source, analysts do a lot of work looking at your cash flow, seeing how high your cash flow is and how sustainable it is. Because not every business generates steady cash flows, and as we've seen with the cash conversion cycle, it takes time. But analysts will analyze, that's their job, by looking at the financial statements and calculating cash flow measures. A couple are given here in this learning module. Once again, much more in FSA, in financial statement analysis, particularly on the calculation of free cash flow. So we'll mention it here. First definition we'll give you is CFO, cash flow from operations. That measures the cash received from customers, so what you got in as cash from making sales, plus any interest and dividends you receive from investments, less your operational expenses, what you pay to suppliers and employees, what you have to pay in taxes and interest. That will give you CFO. The downside, not all of that CFO is free cash. Some of it will have to be reinvested in the business, capital investment, replacing property, plant, and equipment that's worn out or expanding. To measure what's free, analysts will take CFO and knock off that required investment in long-term assets to get a measure called free cash flow. Now, as I say, we've looked at it here. That's all we're going to say. When you get to FSA, you'll see a lot more detail on this, and we'll actually define two forms of free cash flow. Free cash flow to equity and free cash flow to the firm. Neither of them will be calculated exactly like this. So there is a little bit of inconsistency. Don't stress about that. If this came up in an exam situation, they'd make it clear how they want you to calculate it. Next up, secondary sources of liquidity. Using secondary sources may well disrupt your operations. So on a day-to-day basis, you really want to avoid this. Uses of secondary sources might signal deteriorating financial health. What are those sources? Well, suspending or reducing dividends to shareholders, potentially going to upset them. Delaying or reducing capital expenditures. Downside of that, you may lead, or rather it may lead to missed opportunities. You're not investing in positive NPV projects. Curriculum gives a good example here of the airline industry. During COVID, obviously big problems for the airline industry. Had to turn to secondary sources of liquidity. The example I give here is Delta Airlines. Delta delayed their CapEx program. They had planned to spend $500 million USD upgrading their fleet, deferred it till post-COVID. You could rather issue equity. Downside of that, it dilutes existing shareholders' shareholdings. Again, the airline industry. Lufthansa this time, again during COVID, issued a $600 million convertible bond. Okay, it's a bond, but it is convertible. When converted, it will turn into equity and dilute shareholders' holdings. You could renegotiate contract terms. What does that mean? Effectively restructuring, pleading with your providers of debt to turn short into long-term debt, renegotiate rent, lease terms, and so on. You could sell assets. What value are you going to get, though?